Welcome to The Explainer. Today, we're unpacking a massive, often completely hidden vulnerability in global trade. And to really grasp what's at stake here, we're going to frame this analysis like a cinematic corporate comic book. Meet Logi. Logi is our logistics hero, and he's about to embark on a seriously high-stakes financial rescue mission. So picture this dramatic cold open. You've got a massive anchor corporate, let's call them Swiftcard, and they are staring down the barrel of a total supply chain collapse. But the threat isn't some global disaster or a massive shipping strike. The entire system is freezing up simply because one tiny, invisible, deep-tier supplier is running completely out of cash. Enter Logi. His mission is to save Swiftcard's production run before it's literally too late. You see, this tiny Tier 3 SME supplier might just be making a specific screw or maybe a specialty resin, but without them, the finished product just doesn't get built. Right now, these invisible SMEs are the absolute most critical infrastructure in the global trade network, and the scary part is they are incredibly financially fragile. Let's take a quick look at the evolution of trade finance to see how we got here. In the past, we relied really heavily on traditional factoring. Presently, we've upgraded to Tier 1 supply chain finance, which is fantastic, but really only for direct suppliers. The future, though? The future is deep-tier supply chain finance. Because while we've made significant progress over the decades, historically, we just haven't been able to reach those deepest, most vulnerable layers of the supply chain. Now, what's really interesting about this is the sheer scale of the missed opportunity. It's staggering. We are looking at a $17 trillion global supply chain finance market. But a huge slice of that liquidity goes straight to the big Tier 1 suppliers. Meanwhile, there is only this tiny, almost microscopic sliver actually reaching the Tier 3 SMEs that need that cash the most. Section 1. The limits of traditional finance. You see, traditional supply chain finance is essentially a single-layer credit model. It stops dead at Tier 1. The reality for the deeper tiers, the Tier 2s, 3s, and 4s, is pretty harsh. They suffer from massive information asymmetry. Banks simply don't have visibility into their day-to-day operations. Because of that, these suppliers become price takers. They're left completely exposed to severe economic shocks and are forced to rely on exorbitantly high-cost overdrafts just to keep the lights on. The stakes here are truly existential. This quote from Liquidity really hits the nail on the head. One delayed payment at the top can become a survival crisis at the bottom. Think about that for a second. It highlights this incredibly painful irony in global trade. The companies that are shouldering the most operational risk, the ones doing the literal heavy lifting at the bottom, had the absolute least financial support. Section 2. Enter deep-tier finance. So what's the solution? It's deep-tier supply chain finance, or DTSCF. Think of this innovative financial solution like a cascade. It takes the strong, elite credit rating of the anchor buyer, Swiftcard in our story, and leverages it to unlock working capital for suppliers deep down in the ecosystem. It literally lends Swiftcard's massive financial credibility downstream to those invisible, forgotten links. Now, you can't just throw money randomly down a supply chain, right? According to the Asian Development Bank, true DTSCF has 4 strict core rules to make sure credit risk doesn't deteriorate. First, it must be trade-related. Second, it has to be based on an irrevocable payment obligation from the anchor. Third, it absolutely must be post-shipment. And finally, the goods or services have to be linked directly to that specific anchor buyer's supply chain. Section 3. Building the digital bridge. Let's move to the mechanics and see how this builds step by step. First, Swiftcard issues an irrevocable payment obligation for a finished order. Then, the Tier 1 supplier takes that digital obligation, splits it, and transfers a portion down to Tier 2, who then does the same for Tier 3. Finally, our Tier 3 SME takes that transferred obligation to a bank and gets cheap, immediate funding based entirely on Swiftcard's rating, not their own. It's brilliant. To really ground Logi's mission in reality, let's map this out using the Asian Development Bank's flowchart. Look at the anchor buyer on the left, issuing the IPO. Notice how the benefit of that financing physically cascades across the platform. It partially pays the Tier 1 supplier, then moves to Tier 2, all the way down to Tier N. The whole time, the credit risk is safely locked in at the very top. When you compare the financing costs, it's an absolute game changer. A standalone SME loan is astronomically expensive precisely because of that information asymmetry we talked about earlier. But with anchor-backed DTSCF, the cost absolutely plummets. This digital bridge effectively eliminates the unfair penalty that SMEs usually pay just for being small and invisible. Of course, pulling this off requires some incredibly sophisticated tech. Blockchain is the critical enabler here. On platforms like Bancor or Hyperledger Fabric, the payment undertaking is tokenized on a distributed ledger. That creates ultimate, immutable traceability. Basically, it takes fragile commercial trust and transforms it into hard, analyzable, bankable data. Section 4. A resilient ecosystem. Breaking down the benefits, it's clear we are looking at a total win-win-win scenario. The Tier 3 SME gets an affordable financial lifeline and real operational stability. SwiftCart secures their supply run and massively reduces their fraud risk. And the financier? They get to expand their client base into previously unreachable markets while keeping non-performance risk incredibly low. Extending financial oxygen downstream isn't charity, folks. It's just brilliant business strategy. And hey, there's actually an unexpected yet massive bonus to this digital bridge: ESG compliance. Because you now have visibility deep into the network, you can actually verify environmental and social objectives. You can even create tiered financing structures that reward green practices with better lending rates. For massive anchor buyers, this is a revolutionary tool for finally achieving and tracking Scope 3 emissions compliance. So the crucial point is, this isn't just theoretical science fiction. $70 billion. That's a real number. A real deep-tier supply chain finance program over in China successfully pushed $70 billion down through 9 distinct levels of the supply chain. It absolutely proves that this framework can fundamentally restructure global trade at a massive scale. And just like that, Lodge's mission is a success. The production run is saved. This digital bridge has finally brought vital financial oxygen to the forgotten links of the chain. By recognizing and actively supporting the invisible supplier, SwiftCart hasn't just put out a fire today, they've fortified their entire global network against the inevitable shocks of tomorrow. As we wrap up today's explainer, take a hard look at the complex webs that make up modern business. You have to ask yourself, will you leave your deep-tier suppliers in the dark to face the next crisis alone? Or will you build the bridge?